Alright guys, so in this section we'll be learning about two different strategies on counter trend trading, which is the Bollinger Mean Reversion and the capitulation. But before we go into the strategy itself, you have to understand a concept that's going to help you to anticipate reversals in price. We're going to cover this in lesson 4, which is called divergence. We're going to use divergence to anticipate reversals in price. So first and foremost, what does divergence mean? So to diverge means to go opposite. Okay, so that's what it means basically, right? And we are going to look for divergence between the price trend, right, and the indicator trend. So you can use any indicator. You can use MACD, stochastics, RSI, force index. So there are many indicators that can show you divergence. We're going to focus for this lesson mainly on the MACD indicator, but you will see later on that we can also use it on stochastics and RSI, which is another indicator, right? So basically when we see that the price of the stock is going up, right, making higher highs, but the indicator is making lower highs, then there's a divergence. That means it's going opposite, and that indicates that the price is going to reverse down, right? So more on that later on. At the same time, if you notice that the stock price is making lower lows, right? Making lower lows, going lower, but the indicator is making higher lows. So that's again a divergence, doesn't match. So it's an indication that the price is going to, right, that's right, start to reverse back up again. All right, so in a nutshell, that's what divergence means. Now, there are many types of divergence, but for the purpose of this lesson, we're going to just focus on two of them, all right, which is the normal bearish divergence and the bullish divergence. Okay, so just two, that's it, right? So bearish divergence is what we use to anticipate a reversal from the top of an uptrend. Okay, so in other words, when do we look for bearish divergence? We look for it when the stock is at the top of the uptrend, like so. So you can see in this particular case, the stock is on an uptrend, right? It's going up on an uptrend. And at this point over here, you can see it's at the top of the uptrend. It's at a new high of the uptrend, okay? So at a new high of the uptrend, we're thinking, okay, is it going to go higher or is it going to reverse, right? So, and that's why at the top of the uptrend, we're looking for signs of a bearish divergence reversal, okay? Which I'll show you in a while what it looks like. So again, divergence takes place when there's a conflict between the price trend and the indicator trend. So later I'm going to put in the indicators and you're going to see what I'm talking about. That basically the price is making new highs, right? The price is making higher highs, but you're going to see later the indicator is making lower highs, which tells us that again there's a divergence, which means that there's a high chance the price is going to reverse down. Hence we call it bearish, right? Bearish reversal, okay? Next, bullish divergence. So bullish divergence is used to anticipate a reversal from the bottom of a downtrend. So remember, for bearish divergence, when do we look for it? That's right, at the top of the uptrend, all right? Because we're anticipating a reversal back down. But for bullish divergence, we look for it at the bottom of a downtrend because we're anticipating a reversal back up, okay? So in other words, this is the chart we're looking at. So you can see that this is a downtrend and we're looking for bullish divergence at the bottom of the downtrend, which is right there, right at the bottom of the downtrend when it makes a new low, a lower low, okay? So at this point, we're wondering, okay, is it going to go lower or is it going to reverse back up? Hence, we're looking for a bullish pattern, okay? So we're looking for that bullish divergence, which means we want to see as the price is going down, okay, the indicator is going up already, okay? And that tells us that there's a high probability that price will reverse back up over there. And that's where we want to go long, we want to buy, right? Conversely, that's where we want to have to sell, right? To sell to catch that down and to buy to catch that up. So with that, let's go deeper into understanding the steps of the concept. Alright, so now let's throw in the indicator so you know what I'm talking about when I talk about divergence patterns, right? So back to bearish divergence. Once again, when do we look for bearish divergence? That's right, at the top of the uptrend. Okay, so again, this is the price chart, and right now we are at the top of the uptrend, making a new high. Now, one thing you have to remember is that when we look for bearish divergence, we always connect and compare swing highs, right? Drill that into your mind. Okay, for bearish divergence, we always connect and compare swing highs. So, what do I mean? What are swing highs? Well, that's a swing high, that's a swing high, and that's a swing high. There you go, right? So what we're going to do is we're going to compare the price chart's swing highs to the indicators chart's swing high. So below the price chart, I have got an indicator chart, which again could be any indicator, for example MACD or stochastics or RSI, any indicator, even force index, right? So on the price chart, we circle the swing highs, and on the indicator chart, we will also circle the swing highs, like so. Okay, so what do we want to see in order to spot divergence? We want to see that the price chart is making higher highs, like so. Okay, so in other words, you can draw a line from the previous swing high to this swing high, and it's kind of like going up. It's making higher highs. But correspondingly, on the indicator chart, we want to see the opposite. We want to see that the indicator is making lower highs. There you go. So price makes higher highs, indicator makes lower highs. That's divergence. So once you see that, there's a probability that the price will start to come down. So as a counter trend trader, that's when we want to sell short. We want to short the stock to profit as it comes down. Of course, later you're going to learn in the strategy section that you got to put a stop loss up there in case you're wrong and it goes back up again. You got to get out, all right? And as it goes down, you want to be able to take profit somewhere here to close the trade. Okay. Now, a few important concepts you have to understand would be, number one, all right, how do we choose the swing highs? I mean, do we take this swing high and that swing high, or this swing high? You know, which one do we take? All right, and the answer is you can take any two swing highs, but the two swing highs that you take, you must be able to draw a line to connect the two swing highs without intersecting any price in between. Okay, more on that later on, but just understand it for now, right? So I repeat again, when we connect two swing highs with a line, in this case the dotted line, that dotted line cannot intersect any price in between. If it does, it is not valid. Right? Now, once we choose the two swing highs on the price chart, we have to ensure that the two swing highs on the indicator chart are vertically aligned. Okay, that means this should be aligned to that, and that should be aligned to this. There we go. Swing highs on the price chart must be vertically aligned to swing highs on the indicator charts. Now, it doesn't have to be exactly aligned. It could be one or two candles off, but it has to be more or less aligned. In other words, you can't compare this swing high here, right? You can't compare this guy here to this guy here. No, you can't, because it's misaligned, right? But these two are aligned. You can compare these two with these two which are aligned. Savvy? Fantastic. Now, at the same time, you have to also ensure that the line connecting the two swing highs on the indicator chart doesn't intersect any other lines in between as well. So let's look at an actual chart to better understand, right? Okay, so here was a bearish divergence that appeared on General Motors, and this was a couple of years ago, right? So where was it spotted? It was spotted right at this point over here, okay? So first of all, this over here was the top of the uptrend at that time. So we're looking for a bearish divergence to sell the stock, short the stock. Okay. Now again, remember for bearish divergence, we always connect and compare swing highs. Okay. So this is a swing high, that's a swing high, that's a swing high. So there are multiple swing highs. Okay. So we want to connect two swing highs. Now we could connect these two swing highs, or we could connect this swing high with this swing high over there. Right? So which one did I choose? I chose this one and this one, connecting these two swing highs. So why didn't I connect this swing high to that swing high? That's right, because it violates the rules. Because you can see that if I connect these two swing highs, the line intersects the price, which cannot happen, right? So you cannot connect these two swing highs. Now, do you understand what I'm talking about? Okay, great. So that's why I have to connect these two swing highs. Now, as I connect these two swing highs, I look down at the indicator. In this case, the indicator I'm using happens to be the MACD indicator, right? So I'm also looking for the two swing highs on the MACD, and they must be vertically aligned to the two swing highs on the stock price. So in this case, you can see that MACD made a swing high over there. And we're looking at the black line, by the way. The black line is the MACD line, okay? And over here, you can see that it made a swing high as well on the black line that vertically aligns to the price swing high. So they're aligned, okay? So the two swing highs, you can draw a straight line. It doesn't intersect any price in between. And these two swing highs, again, you can connect them without intersecting any price in between. Now, could I have, for example, connected this swing high here to this swing high here? Could I have done that? Let's see. If you were to connect these two, yes, you could have done that because it doesn't intersect anything in between, right? But on the price, you can see that it did intersect that, so you can't use that. So they must both be drawn without any intersections. That's what I'm talking about, basically. Okay? Now, and you see higher highs and lower highs? Yes, you do. So the price makes higher highs and the indicator makes lower highs. So that tells you that is a bearish divergence you have just spotted, which means there's a probability that the price is gonna reverse back down. Okay? So exactly where do we sell? Exactly where do we put a stop loss? That would be in the strategy lesson. But for now, I just want you to understand this concept. Okay. By the way, this is only, you can only confirm this as a swing high only when the next candle has closed. Does that make sense? So only when this candle has completed can we confirm that that is a swing high. Why? Because, let me just draw this over here. Because if this candle has not completed, okay, you never know, right? It could be by the end of this day. Again, these are daily candles, right? Well, you could apply them to hourly candles as well if you're trading intraday, but for now we're looking at daily candles, right? So say by the end of the day, this price happens to close there or make a new high there. Then what happens? Then this one becomes the new potential swing high, not this anymore, because this makes a higher high. Does it make sense? So you only know that it is the highest point only when the next candle closes. Then that's confirmed. Okay? So always remember that. And I want to see that after the swing high, the next candle that closes is a bearish candle before I go short. Now, what if this is a bullish candle? Then I have to wait for a bearish candle to appear before I'm confident that, okay, maybe we are going down and we can start to sell short. All right? All right, here's another example on CABO. And again, the bearish divergence appeared right after this swing high. All right, so again, we look for bearish divergence at the top of an uptrend. So you can see that at this point over here, that was the top of the uptrend for CABO. And we are looking to connect and compare swing highs. So this is a swing high over there. So again, recall that you only know this is a swing high only when this candle has closed. That confirms that this is a swing high. Okay? So where were previous swing highs? Well, this was another swing high. This was a swing high. This block, but this was a swing high. Right, so there are many swing highs. And again, like I said, you can connect any two swing highs as long as they do not intersect any price action. So could we have connected this to this? Yes, we could. Could we have connected this to this? Yes, we could. Could we have connected this to this? No, we can't, because that intersects the price. Got it? There we go. So I happen to connect this swing high to this swing high. Why did I do that? Because vertically down, you can see that this corresponds to this swing high over here on the MACD, and this corresponds to this swing high over here on the MACD. Right, and they are both not intersecting anything. So those were the two ideal swing high points to connect. And I can see clearly that the price is making higher highs, higher swing highs, and the MACD is making lower swing highs. So that's a divergence, which tells me there's a high probability that the price is going to reverse down from there. Now, how down we can never predict, but it's going to go down. Okay. Now, notice at this point, this also happens to be a bearish pin bar. Okay. So when you see a bearish candlestick pattern, like a bearish pin bar or bearish engulfing, that's even better. All right. And we will sell short. All right after that bearish pin bar. Okay, and you can also wait for a bearish candle to appear, but normally once I have a bearish pin bar, I can enter short even before I have a bearish candle to confirm that, because a bearish pin bar by itself is a reversal pattern. All right. All right, so now let's go on to bullish divergence. I do hope now you understand the bearish one clearly. Okay, on to the bullish. All right. So recall that for bullish divergence, we are now looking for it at the bottom of a downtrend. Okay, at the bottom of the downtrend, we're looking for bullish divergence. So if you look at the chart over here, price chart, you can see that it's on a downtrend and it's right now at the bottom of the downtrend, at the lowest new low. All right. And then we have got the indicator chart over here. That could be a MACD. Okay. So for bullish divergence, recall that instead of looking at swing highs, we look at swing lows. So again, please burn that into your brain. For bullish divergence, we connect and compare swing lows. So what's a swing low? Well, that's a swing low, and that's a swing low, and that's a swing low. So we connect any two swing lows, again, same thing, ensuring that it doesn't intersect any price in between. So we could connect these two swing lows if we wanted to. We could have also connected these two swing lows. Both are valid, right? So it so happens that for this example, I connected these two swing lows. Now, on the indicator chart, you have to also look for the two swing lows that vertically align with the two swing lows on the price chart, which happens to be these two swing lows, right? You can see that it is vertically aligned. Okay, there we go. And we want to see that the price is making lower lows. Okay, so you connect these two swing lows, the line's going down, but the indicator is making higher lows. So lines going down here, lines going up there, that's a divergence. So that's a leading indicator that the price is likely to reverse up from that swing low. And we are looking to buy, right? To go long here, to buy and catch the bounce up. That's why it's called a counter trend trade, because we are buying against the downtrend, because we're anticipating a reversal into a new uptrend, or at least to a new swing high over there. Okay, so like I said earlier, the swing lows on the price chart must be vertically aligned to the swing lows on the indicator charts. And both lines, when you draw the two lines, they cannot intersect anything in between. Let's look at some bullish divergence in action. So over here we have got the SPY, S&P 500 ETF, and bullish divergence appeared on the 9th of March. All right, so at this point over here, the 9th of March, we had bullish divergence again. So at this point, it was the bottom of the downtrend for the S&P 500. In fact, this was the bottom of the financial crisis, the subprime mortgage crisis. So this could have gotten you to anticipate when was the bottom and when to catch the reversal. All right. So you can see that was the low of the downtrend, and that's a swing low, and this is another swing low. Again, this was a swing low as well. Okay, this was a swing low as well. This was also a swing low. So there are multiple swing lows. You could have connected this to this, this to that, this to that, right? So anyone, you can connect any two swing lows as long as they don't intersect anything in between. That's valid. Okay. So in this case, I decided to connect this swing low to this swing low over there. And then I look down at the indicator. I'm looking at MACD in this case, and I'm looking at the corresponding swing low on the MACD chart. So that's a swing low over there. That's a swing low over there. Okay, so they're both vertically aligned. And then I connect the swing low. So I connect this swing low to that swing low to draw a line, and connect this swing low to that swing low to draw a line. So I've got two lines right now, and I want to see that one line's going down, one line's going up. Okay, so sure enough, on the chart, the price is making lower lows, and the MACD is making higher lows. So there we have it. We have got divergence. And again, so happens that this candle is a bit of a pin bar. Okay, pin bar over there. And again, we can only confirm that's a swing low only when the next candle has closed with a new higher low. All right, so once that has happened, we say, okay, there's a high chance it's going to reverse. We can start to buy and go long and catch the reversal back up. There you go. Easy peasy, lemon squeezy. Another example on Goldman Sachs. So this was back in 2015, a couple of years ago. And again, this over here at this point of time, this was the bottom of the downtrend and where we spotted a bullish divergence pattern. So again, that is a swing low, and we're looking for previous swing low over there. That could be a swing low as well. So again, there are multiple swing lows. You can connect any two. We could have connected this to this as well, but that wouldn't have worked. Why wouldn't this work? Because from the MACD, you can see that there was no swing low here that corresponded to that swing low over there. Okay, so that's why we couldn't have taken that one, right? We had to take this one because there was a swing low on the MACD. And we took this one because it was the new low. And it corresponded with a swing low on the MACD as well. All right, so that's how you decide which swing lows to take, right? So connect these two swing lows, connect these two swing lows. Again, we want to see price making lower lows, okay, but the indicator making higher lows. So we have got a divergence, again, leading us to anticipate a change in the price action. Again, this happens to be a bullish pin bar, right? So although it's a red candle, but it's a bullish pin bar because it's got a long lower shadow and a small upper body. So that's a bullish pin bar, right? And again, because it's a candlestick pattern, we could immediately buy at the high of that pin bar. Okay. Now, if you're more conservative, you could wait for a bullish candle to confirm it, like this one, before you buy. And that's fine as well. But of course, you get in a bit at a higher price. So it depends on, again, the more conservative you are, the higher price you pay to get into a trade.